Welcome to the Explainer. Today we're going to trace the journey of your money, from your wallet all the way to the nation's vault. We're going to break down the Indian banking system and see how it really all connects. So, have you ever wondered who really decides the interest rate on your home loan? Well, I can tell you it's not your local branch manager. The real answer is wrapped up in this huge, pretty fascinating system, and it all kicks off with a simple question. And that question is, what even is a bank? Let's get right down to the basics. What does a bank actually do? You might be surprised. The official definition is super simple, but it's literally the engine that powers our whole economy. Okay, so here it is, straight from India's Banking Regulation Act of 1949. It really just boils down to this. A bank is an institution that collects deposits from people, from the public, and then uses that very same money to give out loans. That's it. It's this two-way street, this constant flow of money in and out that keeps the whole economic machine humming. But wait, it's not quite as simple as just money in, money out. Every single bank, and I mean every bank, is performing this constant, really delicate balancing act. So on one side of the scale, you've got liabilities. And what are liabilities? Well, that's your money. It's the deposits the bank owes back to you. Then, on the other side, you have the assets. These are the loans the bank gives out, the stuff that earns them money through interest. And let me tell you, a bank's entire survival depends on keeping this perfectly balanced. Now, here's where it gets interesting. When we talk about those liabilities, the deposits, they're not all created equal. You've got what are called demand deposits. Think of your savings or current account. You can pull that money out anytime you want, right, on demand. But then you have time deposits, like a fixed deposit or FD. That money is locked in for a specific amount of time, which gives the bank way more stability and confidence to lend it out. Okay, so we have all these individual banks, each doing their own balancing act. But who makes sure they all play by the same rules? Who keeps them all in sync? Because your local bank branch isn't just an island, right? It's part of this giant, massive financial orchestra. And, well, every orchestra needs a conductor. And in India, that conductor is the Reserve Bank of India, the RBI. It's our central bank. It's the ultimate regulator. You could almost call it the big brother of the whole banking structure, watching over everything to make sure the system is stable and safe for all of us. The RBI is really the one setting all the rules of the game. It decides who gets a license to even become a bank. It sets the guidelines for everything from where you can open a branch to how many ATMs you need. It regulates all the different kinds of banks, public, private, you name it. And yeah, it even has the power to cancel a bank's license and shut it down if things go wrong. It's all about one thing, keeping the entire system stable. But the RBI's job is so much bigger than just being a watchdog for banks. It's actually managing the health of the entire Indian economy. And to do that, it has this amazing toolkit it uses to control the flow of money. The best way to think about this toolkit is like the controls in a car. First, you've got the quantitative tools. These are like the gas pedal and the brake. They affect the overall amount of money in the system, either speeding up the whole economy or slowing it down. Then you have the qualitative tools. This is your steering wheel. It doesn't change the speed, but it lets the RBI steer credit and money towards specific parts of the economy that might need a little help. Okay, so let's talk about that gas pedal for a second. The most important, most powerful quantitative tool is something called the repo rate. So what is it? Simply put, it's the interest rate the RBI charges when it lends money to other commercial banks for a short time. And this one rate, it's like the master switch. It has a knock-on effect on pretty much every other interest rate you can think of in the country. So how does this actually work in the real world? Let's imagine prices for everything are going up way too fast. Inflation is getting out of control. To put the brakes on, to cool the economy down, the RBI can raise the repo rate. A higher rate means it's now more expensive for banks to borrow money from the RBI. And on the flip side, what if the economy is sluggish and needs a little push? Well, the RBI can hit the gas by lowering the repo rate. Now, borrowing becomes cheaper for banks. And what do? They're encouraged to lend out more money to businesses and to people like you and me, and that helps kickstart growth.
All right, so that's the gas and brake. Now let's grab the steering wheel. This is where those qualitative tools come in, like something called priority sector lending, or PSL. This is a rule from the RBI that says banks have to lend a certain chunk of their money, or talking 40%, to specific crucial sectors. Think agriculture, small businesses, the real backbone of the Indian economy. This is so important because it ensures that the parts of our economy that need capital the most actually get it, so they can grow and create jobs.
Okay, so an interest rate just changed. Big deal, right? Well, this is the exact moment where all this high-level economic stuff connects directly to you. When you hear on the news that the RBI has changed the repo rate, it's not just some boring financial jargon. Nope. That one decision is about to ripple all the way down and hit your wallet. So let's actually trace that journey. How does a decision made in a boardroom at the RBI headquarters in Mumbai actually end up changing your monthly bank statement? It's all about the ripple effect. Here's how it works. Step 1, the RBI lowers the repo rate, say from 5% down to 4.5%. Okay. Step 2, now banks can borrow money from the RBI much more cheaply. Step 3, they usually pass those savings along to us, the customers, so they lower the interest rates on their loans. And finally, step 4, your EMI on that car loan or home loan you've got, it goes down. More money in your pocket. So the next time you hear that the RBI has changed interest rates, you'll know it's not just a headline for the business channels. It's real news. It's a change that's going to show up sooner or later right there on your bank statement. It's designed to do exactly that. So there you have it. The RBI's toolkit is what helps our country navigate through all kinds of economic storms. By controlling the flow of money, it's constantly steering the nation's economy. But of course, the economy never stands still. And that leaves us with a big question, doesn't it? What's the next challenge on the horizon?